A very good morning to everyone and a big thank you to Professor Bakshi for agreeing to do this. I'm Ankit Kanodia from SmartSync Services, a SEBI registered investment advisory firm. This is the first episode of Investing Carwan, a new Mission Smile initiative where we are going to invite investing stalwarts every month and learn from their vast experience in the investing field. Before we begin, I would request everyone to please keep yourself on mute and switch off the video so that we can have a seamless discussion and soak in all the wisdom. You may type in your questions on the chat box. In the end, we will have 15 minutes for your questions. So let's begin. Professor Bakshi needs no introduction. He is the father of value investing in India. He is instrumental in spreading the wisdom of Warren Buffett and Charlie Munger, not only in his classroom at MDI earlier and now Flame University, but also in his virtual classroom for over 2 decades now. Just type a prof called Sanjay Bakshi on Google and you would get to know about his early life and struggle. I have read that post at least 10 times in the past 10 to 12 years, and each time I can't stop myself until I read the whole post. I can go on, but I know we want him to do the talking today. So I'll shut up here. Over to you, sir. It would be great if you can start with an opening remark before we begin with the Q&A.
आशूचा फोन होता. मी सांगितलं तिला थोड्या वेळाने करेल.
Request everyone to be on mute, please.
Ankit, thanks a lot. I know you. This has been a very interesting experiment for us. You have been pursuing me on this for a very long time. In fact, as I opened my email box, the date on which you first wrote to me about this was 3rd of August of 2021. And you actually wrote that you can wait for a long time. So I guess the patience has finally paid off, and there were a lot of glitches in between. There was a plan to do this earlier. Then there was a family event which prevented me from doing this. And then I got COVID again. But I'm happy that we are doing this. And thank you for giving me the privilege of doing this as the first event. I'm sure there will be a lot of highly regarded, highly accomplished investors who like teaching to come on your platform and share their wisdom with you. So I'm very happy to be here. And I've known you for a few years, and I think very highly of you. So I'm glad that we are doing this together.
Thank you. Thank you so much, sir. Thank you so much for and I always believe that it is always worth the wait when it is something for something like this. So I'll not take any more time. I'll straight away come to the first question. So, sir, when I met you for the first time in 2014, I asked you this question inspired by Peter Thiel's 0 to 1. What important truth in investing do very few people agree with you on? And you replied at that point of time, paying up for quality. If I ask you the same question today, will you answer me the same, or it will change given how some of the quality companies are valued today by the market?
So that's the interesting question, and my answer is the same. By the way, very short answer to your question is the answer has not changed, but the context is important. So so when we last talked about it, and I have written about it, spoken about it, the basic idea was that there is this school of value investing called deep value investing, where you are spoiled by a wonderful teacher like Ben Graham, and his idea of investing was to invest in businesses that have stocks which are valued at below liquidation value in many cases, or at extremely low multiples of their normal earning power. And he wrote his book coming out of the Great Depression. 1934 was the first edition of his book Security Analysis, and he was very paranoid about protecting the downside risk. And so I had been teaching this subject for a long time, and in 2014 when we talked about this subject, it had been almost 3 years, and I had sort of transitioned over towards the other side of value investing, which is the Philip Fisher philosophy, which we all know is followed by so many investors around the world, including Warren Buffett and Charlie Munger. So in that context, I said, well, you should pay up for quality, but the key thing here was that you are still a value investor, which means you don't want to overpay for anything. So what I meant then, and what I stand by what I said then was uh, that there are these businesses which have some unique characteristics and they should be distinguished from the ordinary business. The ordinary business has no competitive advantage, has no pricing power. It tends to earn a mediocre or poor returns on capital over the long term. It has usually a levered balance sheet. Now, that doesn't mean that these businesses have no value. Of course, it does have value, but the way to value such a business is not the way to value a high quality business. So that was the distinction that I was making when I said pay up for quality. Um, but since then there is a new term that has been coined, and it's called buy at any price, BAAP, and that's sort of ridiculous in my view. And I've talked about it in the recent past. I never bought into that idea of buying at any price. Paying up doesn't mean that there is no limit to the price that you will pay for an asset, because it's even ridiculous to even try to rationalize it. It's sort of mathematically foolish to even try to justify BAAP, buy at any price. I mean, if you think about it, the total return on a stock that you own, that you buy today, and if you expect to hold it for like 5 years, 7 years, 10 years over your expected holding period, the total return will come from only four variables. And those four variables are the entry multiple of earnings, the growth in earnings that will occur over your prospective holding period, the dividends that will come out of that, and the exit multiple. Because the exit multiple combined with the earnings 10 years out or 5 years out or 7 years out, whatever your holding period is, will determine the exit stock price. So you will have the exit stock price compared to the current stock price that will give you the capital gains, and then you have the dividends which are there. So these are the only sources of return that you will have. And if you change just one variable, which is the entry variable, entry multiple, by jacking up the price, then you plug these numbers in an Excel model, then obviously if you increase the entry price, the total return goes down, because the total return, the other things, earnings growth, the dividends that will come out of those earnings that will grow, or the exit multiple, are sort of independent of the entry price that you pay. So the more you pay, the less the return that you will make. It's so obvious, it's so mathematically obvious, right? And if you keep increasing the price, at some point the return becomes zero, and if you do keep going, then it becomes negative. And another way to think about it is in terms of margin of safety, right? We all know the idea of margin of safety, which is the difference between perceived value and price paid for a stock. If you keep increasing the price paid, the margin of safety must come down, and then it becomes zero, because the value is independent of the price. The value of a stock is nothing to do with the price that you paid for it. So the more you pay for it, the less the money you should make, and you can overpay for it, and then you should lose money. And that's exactly the logic behind thinking about it in terms of mathematics. Now, the thing is that the concept of BAAP is like any other fad. It can have it can produce extraordinary returns for a period of time, and then people start thinking, well, this is the way to do it. And it might have worked for a while, but it is not logical, right? It's not nothing to do with underlying value. So people who have paid very high P multiples for mature businesses, I'm not talking about businesses that are going to grow and grow and grow, like businesses which are still in the very high growth stage. Theoretically, you can pay a high multiple of the current earnings, because earnings are going to grow very rapidly. But there are a whole bunch of businesses in India which are very valued very highly, which are of excellent quality, no doubt. They have great business models. They have wonderful people who run those businesses in terms of their operating skills, the capital allocation skills, and the integrity. But they're mature businesses, which means that their future growth is not going to be anywhere close to the growth that they have seen in the past 20 or 30 years. These businesses have been around for a very long time, but they tend to get sold at very high prices, Maybe because there is scarcity value, maybe because governance is a concern here. I don't want to go into the reason why that had happened, because that will try to justify what markets do. But the point I'm making is that if you're paying a high multiple for a very mature business of high quality, you will only make money if the multiple does not contract over time. And that's something which almost always happens. I mean, look at it, look at the world around you. Google, by the way, Alphabet is currently selling at a P of 20. As businesses become mature, their growth rates must come down, and P multiples 10 years out, 15 years out must factor the growth beyond that period. So if forward growth rates will come down, which will always happen, then multiples must contract. And if you are paying 80p multiple for a business today, which will be valued at 20, 25, maybe 30p multiple 10 years out, then you're looking at a contraction of multiple from 80 to 30 over 10 years. Then the only way that can be offset for you to make money is to have earnings growth which is so extraordinary that it more than offsets the reduction of return that will come because of the reduction of the multiple. And that's a very dumb assumption to make, because we are, as I mentioned, if a business is mature, the earnings growth rate is not going to be extraordinary. If the earnings growth rate is not going to be extraordinary, then the forward multiple must be a normal multiple, mid-teens, maybe low 20s, not more than that. Any model that assumes exit multiples many years out for a mature business to be more than 20, 22, 23, maybe 25 max is something which I think is absurd, and it's foolish assumption in my view. So again, going back to the point that you were asking, pay up for quality in the in comparison to deep value businesses, mediocre businesses, commodity businesses, businesses which have poor returns on capital, but don't make the mistake of paying up too much for a mature business, because then you have a very high risk of having a permanent impairment of capital in the long run.
Thank you so much, sir. So if I got it correctly, just to summarize, you should pay up higher multiple only when you are sure of very high growth. If you are looking for mature businesses, the paying up very high multiple, exit multiple, would be very, very, very difficult. As in, would be a thing which will keep you in danger.
Yeah, and that gets into the behavioral side, Ankit, because when people are paying high multiples, they are obviously very sure. They are sure, obviously, if they were not sure, they wouldn't do that, right? So they are certain. The question is, um, how likely is it that they'll turn out to be right? So history tells us, if you look at base rates, if you look at the trajectory of growth rates of mature businesses, they will always go down. There is again, that's almost a law of mathematics. Growth rates will become normal. Typically, a business cannot continue to grow more than the growth rate of the economy, because if you extrapolate it beyond a point, up to there comes a point time when the business becomes bigger than the economy, and that's absurd, right? So it's almost like proof by contradiction that you can't project very high growth rates perpetually. So growth rates will become normal, but people who are paying a very high multiple, they are, when you said you should be sure, of course he is sure. The question is not if he's sure, the question is the consequences of what will happen if you're wrong. So you have to just think about that part, that what if I'm overconfident? What if I go wrong? Okay, I'm sure about it, fine. But what if I was wrong? What are the consequences? So let's say there is a 10% chance of you being wrong. A 10% chance of you being wrong could result in an 80% drawdown for you. Is it worth it? So you can, when you say sure, what do you really mean by saying that you are sure? Are you 100% sure? And if you're saying I'm 100% sure about this, well, that itself is a problem, because there are no certainties in life. So just mentally think about that. Okay, I'm very confident, but what if I'm wrong? What if I'm 10% wrong? And what are the consequences? Just think through those consequences as to what happens when you pay 80, 90p multiple and the growth rate becomes negative. What happens to the stock? And when you plug that in, maybe you will be more sanguine about your own thinking about the future, number one. Number two, maybe you will adjust for this kind of thinking by changing the size of the position that you'll put on that particular business in the portfolio, and so on. So there are many ways of thinking about it, but the point is, obviously, the guy who is paying 80-90 P multiple, he's cocksure about it. He or she is very, very sure about the future growth rate. Otherwise, it just that doesn't make mathematical sense, right? If he's saying that there is no way earnings multiple will be 30 10 years from now, yes, that is possible only if the earning growth rate of earnings is still 30, 35, 40% 10 years out. How likely is that? Obviously, the guy is very cocksure about it, but what if he was wrong? Let's just give a small chance of his being wrong and the consequences of that. So I think that's the way to think about this.
Thank you so much, sir. So, moving on to the next question. The next question is also related to what I noticed in your office when I met you. I don't know if you still have that Warren Buffett quote fixed in your office or not, but that was the first time I think I read it. The difference between successful people and very successful people is that very successful people say no to almost everything. How have you used this quote in your investing and life? If you can share some examples, that would be great source of motivation for all.
I'll just give a sort of warning about quotes. You have to be very careful about using quotes and not assuming that they are applicable in all facets of life. Context is very important here. I mean, there are situations where this quote is applicable and situations where it is not. Like imagine that I'm wearing the hat of a teacher and students come to me and asking for help. I can't say no to most of them, right? I can't say no that I have to say yes to only the request of a few of your students. I have to say yes to every one of them. So context matters. There are contexts where this quote is hugely applicable, I think. It certainly applies to time. I'll come to the investing part in a bit. It certainly applies to time because we have limited time, right? And that's Seneca's essay on the shortness of life was so right and so applicable in the current world that we live in. So much distraction. People are not focused. They just keep wasting their time, and then by the time they regret about how much time they wasted on something, it's just too late. Now, I've tried to be careful with this thing. I think the quote is relevant in many contexts, and one of the contexts in which it's relevant is how do you allocate your own time to what activity? Is it meaningful to you? Does it add value to you and to your family members and so on? So that was about the applicability of this particular quote in things which have got nothing to do with investing. But when it comes to investing, then also, if you think about it, this applies to investing in quality businesses. I mean, what I try to do right now, but doesn't necessarily mean that it doesn't. It must apply to all kinds of investing. I mean, if you think about it, a broad-based index like the BSE 500 today represents 93% of India's market cap. So if you invest in the BSE 500 index, you are buying almost everything, right? You're saying yes to almost everything. You're buying almost every. I mean, if you add up the numbers, you are basically buying, getting exposure to 93% of India's market cap. It means saying yes to almost everything. And index investing works, right? We know that. There are certain limitations to it, but index investing has worked, hasn't it? So even in the field of investing, saying yes to almost everything has worked. But when it comes to investing in a business with a enduring competitive advantage, then it is almost mathematical here, a theorem here that by definition you can't have businesses with high quality. Most businesses cannot have everything. Can't be high quality, right? So when you talk about quality, you are talking about quality on a dimension. There are weak businesses, there are mediocre businesses, and there are strong businesses, and there are extraordinarily strong businesses. You want to be on the right side of the spectrum, not the left side of the spectrum. And what that means is that you need to have filters. You need to have quantitative filters and qualitative filters, and you need to be able to understand that almost everything out there is not going to pass the quality checks that you have in mind, which means that you need to say no to almost everything, which means you need to have filters for quickly rejecting literally thousands of ideas out there. So in that context, and in that context alone, when it comes to investing, I think the quote is applicable. So again, coming back to the point, context matters.
Right, right. Thank you so much, sir. So, moving on to the next question. Don't ignore base rates has been one of your recurrent themes in investing, which is visible in your blog posts, interviews, and also tweets. Any particular investing example in today's time you would like to use to further expand on this theme?
Yeah, I mean, it's a favorite topic of mine, but again, I think it's a lot misunderstood quite a lot. So I'll make some clarifications here. So what is the meaning of base rates? Is basically looking at historical situations which are similar to the situation that you're examining. And there are many ways of classifying similar situations. So for example, if you're buying into an IPO stock, then you can think about, well, what happened in previous IPOs? So there's a similarity over there. Or if you are buying into businesses at very high P multiples, you can go and figure out what is the averaged out experience of people who buy high P multiple stocks over a long period of time. Or if you are investing in businesses with weak balance sheets, and you can figure out what is the average out experience of people putting money in businesses with weak balance sheet. What happens when economic shocks happen? What happens when the economy is booming, and what happens when the economy is in recession? What happens when there is a external shock to the economy, like COVID happened recently, and so on. Similarly, you can think about the base rates of what happens to people who invest in promotional companies, where the insiders are trying to over promote their businesses because they want to effectively make money off investors. And then you can also think about base rates of investing in certain industries. You know, what is the average out experience of investing in retail businesses, or the airline businesses, or investing in serial acquirers, businesses which tend to grow inorganically? What is the average out experience? And if you do that calculation, historically, if you do analysis, you will find that base rates really suck in most of these situations. The averaged out experience is not good. But that's where the problem begins, because that's the definition of base rate. That only tells you about the probability, right? Base rates only tell you about probability of success based on past evidence. Now, there is a style of investing where the probability of success may be low, but the consequences of success, if that event occurs, if success occurs, is extraordinarily high. And so, on an expected value basis, it may turn out to be a good bet. So a system which has lots of bets with a high probability of failure, where one loses anywhere between 50 to 100% of capital, can still make economic sense if there were just a few bets that will make 10x. So if you're investing in such a system like venture capitalists do all the time, you are not walking away from situations where probability of success is very low. Actually, you like those situations because you want exposure to uncertainty, because some of these ideas could turn out to be 10, 20, 30, 40, 50, 100, 1000x ideas. And you don't need a lot of those ideas. So there is this asymmetric payoffs in equity investing. The max that you can lose in an unlevered position is 100% of your capital. The max that you can make, there is no limit to that, right? So that mathematical asymmetry makes life very interesting for an investor who is thinking in terms of probabilities and consequences instead of only thinking about probabilities. So rather, you tend to acknowledge explicitly by having a highly diversified portfolio like venture capitalists do. You just try to get lucky in a few bets, because the profit on those few lucky ones can more than offset all the losses of the losing bets. Now, this is not what I do, this is not what I teach, but I don't want to say that that's not the right way to think. I think the real meaning of don't ignore base rates is better understood when you think about the idea of Bayesian reasoning, and I've done some lectures on that subject. So when you do Bayesian reasoning, there is this initial hypothesis that you have, whatever idea that you have in mind, which is based on base rate, historical information, um, uh, and then there is information specific to the situation that you are trying to evaluate right now, that you're studying right now. Let's talk about an example. You pick an IPO. The base rates suck, but you know that this company has got certain characteristics which make you feel that this is not like the average company out there. The average out experience is not the same as the experience of the exceptional. So you may come across a business in the airline industry, in the retail business, in highly levered businesses, in turnaround candidates, in serial acquirers, in IPOs, and what have you, where even though the odds of success are low, but there are certain characteristics about the business that you are studying which are very unique, which sort of perhaps dilute the base rate. And therefore, what that means is that, well, yeah, you don't ignore the base rate, it's there in your mind. You know the odds are against you, but you also know that the consequences of success, if this thing works out in a tough industry, could be dramatic. So it could be extremely tough industry, could be airline, could be retail, could be investing in even high P multiple stocks, could be investing in serial acquirers. Not all serial acquirers uh, destroy value. Most do, but that doesn't mean all do. So the question then becomes is to, how do you balance these two things? And so you have to think about base rates. You have to think about the evidence specific to the situation that you're studying. And this is where the problem arises actually from a behavioral point of view. Because when people study businesses and ideas, they lose sight of the base rates. They only focus on the unique characteristics of the businesses that they are evaluating right now. They don't think about how this particular situation or business is similar to similar situations in the past, and how did those fare. And then they don't ask the hard question as to why should this be different. Maybe it will be different, but you won't even know what questions to ask unless you compare them with a body of knowledge drawn from history about similar situations in the past. Maybe this IPO is different, sure, that's fine, but you can't draw their conclusion by only looking at the prospectus of this particular company, by only looking at the presentations made by this company, by only looking at the literature circulated by the people who are running the issue, or by doing some rudimentary search about the industry. You have to actually recognize that this is an IPO. What is an IPO? What really happens in IPOs, and what is the average order experience, and why should this be different? Maybe it will turn out to be different, but then you won't know that unless you compare it with basically base rates moderate your enthusiasm about something, and that's the role that they play when you say that don't ignore base rates. Now I want to add a couple of more points on this. This is all about logical thinking, right? We talked about base rates and rational thinking and Bayesian thinking and combining base rates with situations, evidence which is unique to the situation that you're studying. That all is fine. That's all about how to be a rational thinker. But there is a class of people who are basically quite irrational, and they're essential for civilization because they drive civilization forward. I'm talking about entrepreneurs. I'm talking about startups. I'm talking about people who don't think in terms of probabilities, who are not very rational about it, who are overconfident, who are over optimistic, but who are also resilient, and who think of failures not as the opposite of success, but as an ingredient of success. I don't know who said that, but it's a quote that has stuck with me. And they keep trying, and one day they get lucky, or at least some of them get lucky. But those that do, they propel society forward, they solve big problems, they make a lot of money, they become role models, and we need such people, right? So even Danny Kahneman wrote about it in his book Thinking Fast and Slow. So when you talk about don't ignore base rates, if you think about it, some of the most successful people in the world ignored base rates. They did startups. They did things that were very, very difficult to accomplish, and ultimately they became successful. So the idea of don't ignore base rates has a relevance in the context of rational Bayesian thinking, maybe public market investing, but it is not so relevant in many matters of different contexts, such as startup ventures or investing or being an entrepreneur. I mean, Elon Musk, I remember, once said that when something is important enough, you do it even if the odds are not in your favor. So this is the same point, and it's just important for society or something else. And this is exactly how patriots think, right? I mean, think of Captain Vikram Batra in Kargil War and what he did for the country. He laid out his own life, but if he was thinking about base rates or laws of probability of success, he probably wouldn't have done what he did, right? But he's remembered for what he did, and he sort of ignored base rates over there.
That was really interesting, sir. And I remember when you were speaking about the irrational part, the name which was coming to my mind was Elon Musk only. So there was this famous meeting between Elon Musk and Charlie Munger, where Charlie Munger laid out several reasons how he will fail, and he still went up there and proved him wrong. So of course you can't have that with a base rate, but there are people like Elon Musk, and there are many people, not many, but there are some people like Elon Musk who, for whom you can't just look at base rate and ignore, right?
See,
And
the
but
point
your
is the graveyard of entrepreneurs is full of those who see, all entrepreneurs ignore base rate. Most of them fail. Many of them, some of them succeed. Those that succeed make so much wealth and create so much employment and do so much good for society that from a societal point of view, what I'm saying is that we need such people. So while it may be from a very rationalistic point of view, it may be the wrong thing for you to do because you're not different from anybody else. Uh, and you should, especially when it comes to public market investing, you should. What I mean to say is that you should not ignore all retail companies, because retail companies typically end up, they have a very high mortality rate. You don't have to ignore all airline companies. After all, we have seen what Ryanair has done and what Southwest Airline has done. There are value creating companies in the industry which has one of the highest mortality rates as well. So there is something unique about those people, and maybe you can find the next Southwest Airlines, and maybe you can find the next Ryanair, Ryanair, and so on and so forth. So that's the point I'm making here, that you have to, when you're focusing on the research on the individual company that you're working on, don't overweigh it. Don't forget that it belongs to a class of companies or situations where the base rates are not good. But this is exactly where the investing part becomes fun, right? Because the base rates are low, a lot of people don't want to look at those situations, and you're operating in a pari-mutual system. So the whole sector might be disregarded and may end up becoming a good area to look for value because it's been sort of given up for debt. So in that sense, even highly levered companies in the bottom of a recession are given up for debt, and there are a lot of upsides which are not there, not been factored in the valuation. And Ben Graham used to think like that. So he would talk about investing in businesses which were very inefficient, which were highly levered, which were the most inefficient producers in an industry, because he expected that the price of the commodity that this industry manufactures is going to go up, and if it goes up, then the profits of the most inefficient player, the most levered player, the highest cost producer will go up the maximum, and the stock price will go up the maximum. And he was thinking about just not the probabilities of success, but of the consequences. So the same thing applies to turnarounds. Warren Buffett wrote, "Turnarounds seldom turn." So he doesn't like investing in turnarounds. That's fair enough. That works for him. But that doesn't mean that you should not invest in turnarounds. You should maybe become extremely selective in identifying certain turnarounds which will not behave like most turnarounds do. So average out experience is not the same as unique experiences, and that's the point that I want to leave you with.
Yes, sir. So moving on to the next question. So based on what you wrote in your blog post from 2010 onwards, you clearly made a distinction of being a moat investor since then. Prior to that, you were doing a lot of other stuffs, like you were into arbitrage, you were into special situations. But I think it is 2010 or maybe 11 from when you clearly focused on being a moat investor. And it's been years now. Would you like to share a bit about your experience as to what worked, what didn't work, and how you have evolved as a moat investor in these 12 years? You may take stock names just as an example, or if you may choose not to take stock names as per your.
I won't take stock in, but I'll talk about the basic elementary mathematics of investing in a high quality business is basically irrefutable. I mean, if you are paying reasonable multiple of earnings for a business which will grow its earnings over a long period of time, which earns high returns on capital and is likely to continue to earn those high returns because it has a competitive advantage, entry barriers, and all that. And it is likely that the multiple should expand as the markets sort of start appreciating the inherent quality of the business. You're going to make money, right? I mean, the entry multiple is normal. The exit multiple is higher. How much higher is hard to say, but it should be higher than what it is. And there is earnings growth that you projected out. So, and I'm not even counting dividends. So your return should be at least the earnings growth. If the earnings growth is 15% a year, and there is a multiple expansion from 11 times earnings to 20 times earnings, even if it happens over 6 or 7 years, the expected return on the stock is very, very good, right? So that's the underlying mathematics of it. Now, so that's the easy thing that to understand. Now, can things go wrong? Of course, things can go wrong. I mean, there's nothing, no certainties here. But the things that they go wrong is not because the math was wrong. It's because the what you thought would happen did not happen. So what you thought was a moated business actually turned out to be non-moated one. So there is, just because you have a high return on capital right now and have had in the last 3, 4, 5 years doesn't mean that you are a moated business. You may be, you may not be. I mean, maybe the jump in earnings was temporary and it was superficial and appearances were deceptive. And over time, profits became more normal than what they were. So fundamental impairment took place. So, for example, a business may be facing elevated earnings because some of the competitors have lost customers because of some mistakes that those customers made, and they lost those customers, and therefore the business has shifted to a business that you are evaluating, and that has elevated earnings, and therefore you start thinking that there is something unique about this business, and the competitors who have lost business have no ability to come back. Maybe that assumption is wrong. Maybe they will fix their problems. Maybe they will win back lost customers. And if that happens, then the number of players in the industry will go back to a higher number than was the case post the shift of market share to the company that you are examining. And therefore, the earnings that you thought were normal were actually not normal. They were extraordinary. And of course, in terms of valuation, how to treat extraordinary earnings which will last only a few years versus normal earnings which will last for a long time is obviously very different. The multiples that you'll apply to extraordinary earnings are much lower than you would to earnings that are normal. So that is one thing that can go wrong, that you thought there was a moat, but it was not there. So you made a mistake basically, or the moats got destroyed. Things happen, right? So my favorite example here is investing in a hotel which is in a city which is very prosperous, but it is the only five-star hotel, and nobody else can make more hotels. There are no more permissions, and it is the only asset of the business, and it has pricing power, and the hotel is always full, and so on. But there is an event, there is an earthquake which flattens the hotel. So the value goes to zero because the land was never yours. And imagine that you don't have any insurance. So basically, the value goes to zero in just no time, right? In just a few seconds. So things can happen. Events can happen which can erode the value. See, it's not just competition that erodes a moat. Well, it is normally thought that a competitive advantage is moat and economic castle and all that. There are so many things that can erode a moat. It could be a regulatory change. It could be a change in technology. It could be obviously a competitive attack. It could be management mistakes. It could be so many things, right? So the point is that you may have done your thinking based on, again, studying the history. And one of the things that you tend to do when you study the track record of a business and you like what you see, and you can clearly attribute the current success of the business to certain attributes, you tend to assume that those will continue. Good guys don't become bad guys normally, right? But that's not always the case. People who run the business may have been thought by you at the time of purchase to be fabulous, but the subsequent track record could indicate otherwise, right? Things can happen. They may have gone genuinely wrong in the way they thought about the future, and they may have made some mistakes or in capital allocation. Some of them were significant and resulted in impairment, or they might end up taking actions which were not in the interest of minority shareholders. They had never done it in the past, but they've done it now. So there are all sorts of things that can happen that can make what you thought was a great business turn out to be not to be the case. Um, and of course, you can go wrong in over optimism in terms of projections. You have some ideas about how the business will perform. It did very well under the circumstances, but not as well as you thought. And there was over optimism in your projections. And obviously, if you're over optimistic, you may end up paying a higher price than you should have paid, and that will result in a return which is lower than what you thought you would get. So there are all kinds of things that happen. I'm not even talking about macro things that can happen. I think that will come later. You might have some questions on that. Interest rates could go up. There could be economic collapse. Businesses don't exist in a vacuum. I mean, look at what is happening in Sri Lanka. Look at what is happening in the Russian, so-called monopoly businesses. The actions of one guy can destroy the franchise of so many people. Look at McDonald's in Russia. It's gone. So things can happen, and it's important to recognize that no matter how well the job that you have done in terms of diligence about the quality of the business, the quality of the management, there are all these underlying assumptions about the continuity of the business, which are based on external factors which are truly not in your control and which could dramatically change, and things can go. And that's exactly what makes life fun, right? It's not like there is no investing strategy out there that is bulletproof completely. There will always be some things that can go wrong in anything that you try to do, and therefore you learn as you go along.
Right. I have a follow-up on this, but maybe I'll ask it a little later.
Okay.
So moving on to the next question. I read this book, Modern Monopolies, last year. I think you would have read this too. It was fascinating to read and also simultaneously observe how things were playing out in the Indian stock market. So using your moat investing framework, how do you look at platform businesses? What are the characteristics that excite you, and what are your concerns?
See, platform again is a very, people think it's new, but it's nothing new about it. In fact, there is another book which is, I think Samir Arora recommended, and I think it's a wonderful book. It's called A Platform Delusion: Who Wins and Who Loses in the Age of Tech Titans. So I would recommend that book as well. The thing is that platforms have been around for a long time. I mean, what is a platform? Platform is a connector, right? It's a connector business model. It connects customers with suppliers. Um, so newspapers were platform businesses, right? They connected advertisers with readers. And clearly, if you become a successful platform company, you tend to become very successful. There is this winner takes all kind of attribute. I mean, Google is a platform company, and in terms of search engine revenues, it probably takes more than 90% of the revenues of all search engines out there. So the next 20 search engines will get 10%. And that's not unique to technology platform company. That has also been the feature of platform businesses even before the internet came into existence. The newspaper is a classic example, right? If you even look at Indian newspaper industries before the internet came into existence, Times of India in Mumbai and Statesman in Calcutta and the Hindu in Chennai, they were like dominant, and Hindustan Times in New Delhi. These are dominant papers, and they were extraordinarily profitable businesses, right? And once you have got that advantage, it's hard to be dislodged from that sort of pedestal. So those are features that have been always been present in platforms. But of course, technology platforms have the unique benefit of high degree of operating leverage, extra revenues result in extra profits. All that is wonderful. But I have concerns. You asked me about concerns, and I've always had these concerns. And one of the concerns that I have is that there is a tendency to believe that once a platform company becomes dominant, it's hard to be displaced. It almost never happens. That's not true. Google is not the first search engine. There was a social media platform called MySpace, which was wildly more popular before Facebook came. So Facebook came and turned it. So think about this for a moment. Let's just talk about human psychology. Think about malls. You have these malls, and there's this mall called Ansal Plaza, which was a very popular mall which came into existence some 15-20 years ago in Delhi. It was a place where people hung out all the time. Youngsters would go there, families would go there. It was a cool place to go. But then Gurgaon came up, and then Vasant malls came up, and then Saket malls came up, and people moved. So the thing about platforms, there's a lot of social proof out there. People go there because people go there, um, but people can change, and crowd behavior is hard to predict. While at the time when you're studying a platform company which is very dominant, it seems at the time, of course, that nobody's going to shift. Think about BlackBerry, the phone that had very sticky customers because people were hooked on to BBM. And if you're on the BBM platform, BlackBerry Messenger, those of you who are new may not even know the term. It was a very, very powerful platform because you could message anybody else on a BlackBerry. It was very secure. Almost everybody had Blackberries, and you had BBM. Now you have iMessage, you have WhatsApp, which can go across very technological platform. They can work on Android phones, they can work on Apple phones, they can work on any phone. But BBM would work only on BlackBerry phones. So people would buy BlackBerry phones because they had to be on BBM because all their friends are on BBM, and therefore they want to be on BBM. Think about this for a moment. Go and study what happened to BlackBerry. It was abandoned in just a matter of 2 or 3 years by users around the world because a better technology came. So the world of history in platform businesses is full of examples where platforms that appear to be dominant and extraordinarily profitable were subsequently destroyed by something else that came. And it's very difficult to visualize what will come that will destroy uh, Google or Facebook. I can't visualize that right now, but this is exactly the problem here, right? It was very difficult to visualize that what would destroy the franchise of the dominant newspapers. It was very difficult to visualize what will destroy the dominance of BlackBerry. So at the time when those businesses are doing extraordinarily well, it's very hard to visualize or predict that they will go, but they almost always do. Um, so that's the case. The Ansel Plaza Mall is a dead mall now. Nobody goes there because nobody goes there. The reason why people would want to go to a mall because all your friends are going there, all the restaurants are over there, all the stores are over there, all the happening events are happening over there. But when people don't go there, then people don't go there, right? So crowd shift, crowd mentality is a study, is a subject worth studying anyways, and that's part of social psychology. And you should read books like The Crowd or Extraordinary Delusions, and there are a whole bunch of books out there. But the point is that a lot of success of platform businesses is because of crowd behavior, and crowd behavior is very difficult to predict. It can change suddenly, and when it does, then what appears to be very profitable today may turn out to be not so profitable just a few years on the road.
That's a very interesting point, specifically in relation to the crowd shifting to a place or a platform. So I think, don't you think these businesses, these dominant platforms also realize this risk? And if you look at, see, these companies like Facebook, or so just take Facebook's example. So Facebook had also bought in WhatsApp, also acquired Instagram. If you look at Amazon, you can see that they also started their streaming business. In case of Google, they also have YouTube now. So don't you think in these cases, probably, or what is your view? The dominant platform is so conscious about all these risks. They are deepening their moats even more by acquiring other platforms.
Okay, tell me what is happening with Netflix. Netflix started losing users, right? And they
Right.
had the highest budgets. They had the streaming services around the world. They had a subscription
Right.
model, and it was some everybody. You can't afford not to have, Netflix. Everybody was subscribing to Netflix. You want to be there, right? And now they're losing users. So I'm not so sure. Again, the point is, um, 2 years ago, could people have thought that Netflix will have this problem what they're having right now? No. So it's very difficult for me to say how people will abandon Amazon or what will happen. Even the founder of Amazon is conscious about the risk that Amazon will die one day. Um, so while these people are very, very grounded in reality, they follow the founder of Intel's book, Only the Paranoid Survive. They are very paranoid. They know that they are in a space which is changing very rapidly. The landscape changes very rapidly. People's preferences changes very rapidly. And these are very large companies. They become, there is this concept of scale economics, but as Charlie Munger once mentioned, there is the opposite a model of diseconomies of scale. So you become very large, gigantic companies. You tend to become bureaucratic. You have layers and layers of costs which new, nimble upstarts don't have. And those are the guys who will destroy you. And these guys know that, and therefore they're paranoid about it. And therefore they go and acquire an Instagram or a WhatsApp, and though they turn out to be fabulous decisions, but then you have to keep doing the right thing over and over again. It's like, you have to stay lucky all the time. You get unlucky once and you're done. And this is the point. The odds are against it. I'm not saying don't own those businesses, don't invest in them. I'm just talking about odds. That the landscape changes. Uh, it's very hard for me to predict that the phone that I have right now, which is an Apple, I think 11 or 12, will be the dominant phone 10 years from now. While at this time, of course, everybody says there's no way Apple can be dislodged. But if you go back in history and study BlackBerry's, story, you will say exactly the same. What the confidence that people have in Apple is exactly the in terms of the dominance of the smartphone businesses globally, is exactly the degree of confidence they had in BlackBerry. So people do turn out to be wrong about their judgments about how future events will play out.
That was fascinating, sir. And specifically in case of Netflix, probably since they were a focused business only on streaming, that risk is probably much higher than in terms of risk when you compare to something like an Amazon or because they have diversified into other areas as well.
Yeah, I mean, the thing is that Blockbuster was destroyed by Netflix. Prime may destroy Netflix. Who knows? This is the way it is. A life of businesses is full of ups and downs. There will be periods and trajectories where you will have, going up and up and up, and then you will decline. And you will decline for reasons that are unknown to people right now and will be known much after it has happened, actually. So look at what happened to Kodak, right? And when Kodak, Kodak was the company which actually, I think, invented the digital photography, but they never popularized it. uh, Again, the point I'm making is that disruption is here and it's not going away. Being big and rich is not a certain way of ensuring that you don't get disrupted. It may delay it for sure. It may even stop it if you're very smart and stay lucky. But will it be 100% surety that if you have a strong balance sheet, deep pockets, huge number of talent, that you can't be disrupted by some guy in a garage, in some remote part of the world? I'm not so sure about that.
Right, right. So moving on, sir. So I'm currently reading this book called The Payoff. It is also a very good read on how the payment landscape is changing all over the world. And the book was published actually in 2021. And something interesting is mentioned in the book there. So I'll just quote from the book. Facebook is worth a little less than, and Amazon just a bit more than, the sum of the 6 largest banks in the entire world. Of course, after the recent corrections, the statement may not hold true today. But from the Indian stock market perspective, How do you find the banking and finance space vis-a-vis the technological space in the long run? I have read about your dislike for lending institutions in general, barring a few differentiated models which are not very risky. However, would you say that the banking sector in particular may not see the valuation it saw in the last decade due to the emergence of fintech and other technology businesses in India?
See, Ankit, you're asking me to comment about what the market may or may not do in the future, and I have no way of knowing that. So it's not something which I will venture out to make a prediction on. Um, um, the thing about technology is when you look at technology, it's an opportunity, it's a threat. It's a threat for those who don't use it as an opportunity because somebody else will. And it can be a huge way of enhancing the bond with the customer and growing your more. I think the best fintechs are actually inside banks. There are banks which are modernizing, there are banks which have teams, and there are banks which are doing a lot of things. A lot of these so-called fintechs that you talk about, and it's not just my original idea. I like the idea. I read about it recently. They are just relabeled or glorified DSAs, direct selling agents of these banks. They have affiliate relationship with banks. So we call them fintechs, and they're all loss making. They all are raising money from investors. That world has changed the last few months in 2022, and therefore they need money to burn. And fintech is just one class of those businesses, and there are so many others which have similar characteristics. Um, but the point is that banking as an industry is not going anywhere. I think banks are the ultimate platform business, and they're going to be around. They serve a very basic need of society, and that's going to be around for a very long time. Whether technology can disrupt banking, the answer is yes. And of course, within banking, there are banks which are investing heavily in technology and intelligently in technology, and which is enhancing their edge over competitors. And there are other banks who are not doing that. And of course, the ones which are not doing it will lose in the long run. So within the banking space, there will be churn, no doubt about it. And within fintech space also, there are these new kinds of business models that have come which don't make any money but are trying to disrupt the banking space. I think in order to fight an enemy, you need a lot of ammunition and you need a lot of strategy. You may have the strategy, but you don't have the ammunition because the ammunition is not yours. It's coming from your investors. And if they stop giving you the ammunition, then your ability to fight sort of goes away. So again, I go back to my original idea that I don't like businesses which consume cash in the long run and which will keep consuming cash for the longest time, because there will come a time where the access to the cash will stop even momentarily. It's like oxygen. If you don't breathe for 60 seconds or 80 seconds or 2 minutes, you just gonna die, right? So if the oxygen supply is withdrawn for whatever reason, even momentarily, then their ability to disrupt the banking industry will evaporate. And that actually may be happening as we speak. So I do feel that the best technological disruption will be done by banks themselves. Of course, there is massive technological changes that are happening in the payment space, and that's going to be a game changer. And India is sort of leapfrogging into the world's best payment space technology that I'm aware of. And that is going to be extremely disruptive, and it's going to be hugely opportunistic for some businesses out there. No doubt about that.
Thank you, sir. So moving on to the next question, and as you rightly said in the answer to the last question that you don't like making any macro forecast or prediction. However, macro factors do affect businesses. So in this kind of environment where there is a consensus feeling that inflation is there, so are you thinking differently about your investments, or everything is as usual as it was in the last 10 years for you?
See, again, I go back to history. I've been doing this for 27 years, and I've lived through a period when inflation was 15% and interest rate was 17 or 18. Fixed deposits in banks was 17 or 18%. I lived through that period. Now, um, I think it was late 90s, early 90s or mid 90s, sorry. If you look at wealth creation in India in equities since that period till now, it has not been hampered because of inflation. Uh, so inflation, of course, is an enemy of. It's like a tax, right? Buffett has written about it. It's a permanent tax. It's a compulsory tax that everybody has to pay. And there are ways of thinking about it. But the key point to recognize here is that inflation, high inflation, unless it becomes hyperinflation, does not prevent wealth creation to occur. That's one. Number two, what are the choices that investors have? They can invest in fixed income, which are fixed claims, which are going to get completely destroyed because of inflation, or you invest in a variable claim security, which is what equity is, that there is at least a chance of earnings growing faster than inflation and value being created because of that over time, and therefore at least there's a chance for you to beat inflation. And the only asset class in my judgment that meets that criteria is a business that makes money. And there are some businesses that are going to get hurt by inflation. There are some businesses which are going to get less hurt by inflation. And as a consequence of living in a pari-mutuel system, if you are hurt but your competitors are hurt much more than you may actually come out ahead. That's the way the game actually should be understood. So inflation, there are many ways of thinking about inflation. I think one, of course, is the impact of inflation on economic earnings. So there are these capital intensive businesses which have a lot of fixed assets, and these fixed assets need to be replaced. And the replacement cost, because of inflation, tends to grow up quite a bit over a period of time. But you are providing depreciation on original cost. By the time the asset needs to be replaced, there is no money in the firm left because of accounting of a depreciation did not allow you to conserve as much capital as would be required to replace the asset. So your economic earnings are sort of overstated. And that's a technical topic. I don't want to delve into that, but basically inflation will hurt businesses that employ a lot of fixed assets which tend to depreciate rather quickly and need to be replaced, and the replacement cost tends to be higher over time. So that's one thing. But think about this for a moment. If you are invested in a commercial building which has got these tenants, and the tenant and the rents are going up because there is inflation, and the building tends to appreciate over time because it's a well-kept building, it is in a good location, and land values tend to grow over time. Then in this kind of a business, the inflation is actually good for you, right? Because you don't have to replace this building for the next 100 years. It's got a life of 100 years. So the depreciation that you provide on the asset is actually fictitious depreciation, because in the books you're bringing down the value of the building. In real life, the value of the building is going to grow more than the rate of inflation because the rents are growing at more than the rate of inflation. So it depends on the business. You have to be very careful to distinguish between what is this business, how it's going to get hurt. If you think about working capital also, not just fixed capital, inflation has a role here. And this is a point that Buffett made in one of his essays, which is not, I think, fully understood by a lot of analysts. Because I want to highlight this point as to what happens to working capital intensity when inflation occurs. So imagine that you are using 100 units of raw material, uh, and the price of the raw material goes up. You still need 100 units of raw material to make whatever widgets you make, but now you have to pay a higher price for that. So raw material in terms of units is exactly the same, but raw material in terms of INR will be higher because the cost has gone up. So in terms of the balance sheet line item, your inventory will go up simply because of inflation, even though the amount of inventory in kgs or units or liters or whatever it is exactly the same. Because the price has gone up, your inventory in INR terms has gone up. that inventory will eventually become finished product and will get sold to a customer to whom you are lending money. You are still to whom you are giving credit. That customer is still buying those 100 units or whatever 50 units of finished product that you're making as he was doing earlier. But now because you are charging him a higher price because of inflation and because he has been given credit by you, receivables will go up. So the same number of units that have been sold, there's no physical volume growth in the business, but your inventories have gone up and your receivables have gone up. So therefore, your working capital requirement has gone up. In rupee terms, you need more working capital. Business is asking for more working capital simply because of inflation, and it has happened not because the business is growing. Business has not grown. The units that you are selling are exactly the same, but the nominal value of raw material and receivables has gone up, and therefore working capital requirement has gone up. And therefore, if you don't have the money in the bank, then you have to borrow that money, and there's an interest cost, and all that will happen. There's an impact on the P&L, and there's an impact on ROCE because the capital requirements have gone up, and therefore all that has to be thought through carefully on a business to business basis, because businesses that are raw material intensive, inventory intensive, and receivable intensive will also get impacted by inflation. Then of course the impact of inflation is on interest rates. Typically high inflation means higher interest rate, and higher interest rate means higher discount rates in DCF, and higher discount rates, other things remaining the same, means lower value. But this is misunderstood because other things are not the same, because inflation does tend to drive up the prices of products. Is the cause, which is inflation is the effect. The cause of inflation is the rising prices. And rising prices means people have to pay more for things, and if they have to pay more for things, then revenues of the nominal revenues of those companies are going up, and nominal earnings of those companies are going up. Some will go more than inflation, some will go exactly in line with inflation, some will grow with less than inflation, some even decline. So you have to think carefully about what will be the impact of inflation on this particular company. You can't just say, well, other things are the same, interest rates have gone up, therefore in DCF the value will come down. That's not the case. By the way, that is exactly the case with bonds, because in bonds the money that you will be given by the bond issuer will not change in nominal terms. It's exactly the same. They will give you exactly the same amount of interest and exactly the same amount of redemption money 5 years out or 10 years out. And if you have to bring that future cash flows to present value at a higher discount rate than before, which is what higher interest rates would require you to do, that means lower bond prices. So therefore, inflation is a terrible, terrible enemy for bond investors, but not necessarily for stock investors. Then, of course, is the idea of pricing power. There are some businesses which have the ability to increase prices. At least some pain can be passed on to customers without fear of loss of unit volume and market share. And we've seen that. We see a lot of those businesses out there which are basically selling products which are of basic necessity, but that doesn't mean the pain is not there. And look at FMCG companies right now. They're all hurting, right? They're all going through a period of shrinkflation when they are reducing the price of their product, the size of their packaging of their products, just to sort of effectively increase the price on a per unit basis. So they try. There are businesses that will try and succeed. There are some businesses that will try and fail, and there are some businesses that can't even try because they don't have pricing power. So obviously, on a spectrum, businesses which have pricing power will tend to either benefit or get hurt less. Again, I bring back the principle of pari-mutual investing. If you think about it, all businesses in the end are fighting for scarce capital, right? So an FMCG company is fighting for capital, against a company which is in the hotel business and so on. The point is, if you look at it from that dimension, then there are some businesses which inflation will benefit, and some which will be hurt by inflation. And of course, then there are these asset businesses, businesses which are sitting on assets which will go up just because of inflation. Prime land is a case in point. We don't have those companies in India, but timber was a case in point. If you're sitting on on valuable inventory of something that is scarce, which tends to grow in value over time in nominal terms, and that will protect your business from the ravages of inflation. So there are all these ideas about inflation that come to mind, and I remember Shakespeare's quote here that there is nothing good or bad, but thinking makes it so. You have to go deeply into the idea and then think about inflation and its impact on the economics of a business and its potential valuation without making a blanket judgment that inflation is bad for equities in general. It isn't.
So I really like the mention of the working capital thing. And right now, as Q4 results are getting declared and there are so many con calls. So one interesting thing which we have noticed is also that some of the management which had planned for capex, they are now rethinking, because now they probably didn't expect the inflation to rise so much. So now the IRR of those capex are not coming to that attractive a point which they thought of, say, a couple of quarters or a year ago. So this is also an interesting point in terms of inflation.
Not only that, let me add to another nuance here, which I should have mentioned earlier. I talked about the impact of inflation and depreciation, and on businesses. But think about the cash flow statement. When I talk about working capital, same unit volume, no growth in the number of cars that you are selling, or the bikes that you are selling, or the kgs of tires that you are selling, or whatever you are selling, the kgs are the same. But because inventories are more expensive and receivables are carried at a higher nominal price, working capital requirements go up. That incremental change in working capital will be a item that will take away money from free cash flow. Your free cash flow will go down simply because of inflation, even though your business has not grown. Typically, growth in working capital is associated with growth in unit volume. Inflation almost always ensures rise in working capital and therefore a detraction from free cash flow. Those of you who study free cash flow statements, and you should, because it tells you that can this business fund its own growth. Forget growth. To even stay at the same level, you need more capital. So if you don't have the cash, then you have to borrow money. Impact on the balance sheet quality, on the P&L, because of extra interest that will have to be paid because of incremental debt that you take on. So there is this impact all over. Inflation has an impact on the P&L, it has an impact on the balance sheet, it has an impact on the cash flow statement, and it's very interesting to see how that plays out over a period of time.
So I have another follow-up on this. So there are several businesses which generally focus too much on this metric called EBITDA per ton.
Mm-hmm.
So in this inflationary environment, would it not be right for us to not just focus on that EBITDA per ton, but also simultaneously compare it with the actual P&L and cash flow? Because even though on an EBITDA per ton, they would be doing, just as you mentioned, they would be doing the same performance, but actually the business is getting hurt, right?
Absolutely, and I will just make the point that you meant. You said in this environment. I think it applies in every environment. You should not focus on EBITDA per ton in any environment. You should focus on true economic earnings on a per ton basis, or a per share basis, or whatever the denominator is. In every environment, EBITDA is just a number. It's a number which is highlighted a lot because it makes you look better than what you really are. So I just don't like the idea. I'm not the only one. Any financial analyst will tell you the same thing. EBITDA is not earnings. So be careful about EBITDA in any case. And yes, you're right about the fact that because of inflation, companies whose ratio of EBITDA to true economic earnings will become worse because of inflation. That point is completely correct.
Right. So, sir, next two questions will be specifically on valuation. So, the first question would be related to the moated business. So, with your experience, how easy or difficult, or what kind of problems you have come across when you are valuing moated business?
See, the problem is actually about the way the world is changing very rapidly. The pace of change is only accelerating, and it's very difficult to visualize. So one of the filters that I use is that how sure am I that the basic need that this business serves will be around. But it's not sufficient anymore to ask that question. You have to also ask the next question as to how sure am I that this industry will be serving that need. You know, the people need torches to go in the people need light to move around in dark places, and the need was served by torches. But people don't buy torches anymore, right? Because they are built into the mobile phones. So the mobile phone industry disrupted the torch industry, so to speak. Just an example to illustrate the point I'm making. The need may be there, but the need may be served by a completely different industry, and you don't even know that. So you have to be careful about that part. So when it comes to valuation, all valuation is thinking about the future, right? So you are trying to stay away from things that you can't predict, and it's good becoming increasingly hard for one to predict the future in terms of what the business will look like 10 years from now, when you can't even be sure about the need that the business serves, and whether the need will be served by this industry or some other industry. Then how can you be sure about this particular business? So that's one big challenge that I have to face with all the time. The other thing that has happened is that when you're making predictions about the future, how far, as I mentioned, you can't think very far out. So how do you adapt for that? Instead of making explicit forecasts, like I did a case on Relaxo many years ago, and it's out there where I made some assumptions about unit economics and how the per pair economics will change over time, and how the business will use this pricing power and so on and so forth. And they actually turn out to do way better than what I expected, but that's not always the case, by the way. But the point is that this kind of explicit forecasting, which was being done by me as late as 2012, 13, 14, I feel uncomfortable doing it now. So the way I think about valuation now is different from the way I thought about valuation uh, when I did the Relaxo lecture. So my thinking is basically that I don't want to pay at the portfolio level, and this is important. At the portfolio level, I don't want to pay significantly more than what I would pay for a non-growing perpetuity in a AAA bond. So if AAA bonds are yielding say 9%, just take for the sake of example, then the pre-tax multiple is 11, um, and the bond will never pay more. So it's a non-growing perpetuity, and it's AAA, so it's high quality. So you're certain about the fact that you will get the money whenever it is due to you. So what that means is that if I ensure that if I'm buying into a growing perpetuity where I'm sure about growth, uh, I don't want to pay for the growth component at the portfolio level, or I don't want to pay a lot of money for the growth component at the portfolio level. So that kind of thinking basically reduces the need to make explicit forecasts about unit economics, market share, DCF assumptions and all going forward to 10, 15, 20 years. Uh, Now, when I say at the portfolio level, what does that mean? What that means is that uh, there is a way to invest in high quality businesses where you would allow some positions to be bought at multiples where you're paying for growth. You're hopefully not paying a lot for growth, and hopefully you're buying growth at a very reasonable price, but you're paying for growth because the multiple is way more than 11 times pre-tax earnings using the method that I just described. Uh, then, but at the portfolio level, you can still keep the overall multiple not too far away from that what would be paid for a perpetuity in a bond portfolio. And the way to do that, of course, is to keep the weightages of the high P multiple stocks low, and to increase the weightages where you're getting growth for free. So, hopefully and today is such an environment, by the way. We are looking at hopefully a bear market right now, and things are becoming quite interesting. And therefore, there might be businesses out there which will grow their earnings, but are priced at single digit multiples of their pre-tax owner earnings, and therefore one is not paying anything for growth. One is actually getting the growth component for free. So if you increase the weightages of those businesses in the portfolio and still have some businesses which where you're paying for growth and paying up for that quality, then the overall portfolio is still, I think, very, very attractively priced. So that's the way I think about valuation at the individual level, at the portfolio level. Instead of making explicit forecasts, I prefer to, and I've given you the reasons for that. One is that the world is changing, disruption is here, hard to visualize the future, hard to think about the basic, the even the, whether the need that this business serves will be served by this company or this industry or some other industry and so on, and how to still be a value investor and try to bring in some discipline about not trying to overpay for anything.
So if I would like to summarize, would it be fair to say that you want to keep a DCF frame of mind, but you don't do explicit DCF forecast today in your valuation?
That is absolutely correct. DCF frame of mind is very interesting because there are events which happen in the life of a company or of a stock market which makes you become more rational when you think about DCF frame of mind. That for example, when COVID happened, the earnings of many businesses were decimated. But then if you put yourself in the DCF frame of mind, you think along the following lines that, okay, pandemics happen, they've happened in the past, economies bounce back, this company has a strong balance sheet, it's not going to die. At most, it will give up its earnings in the next 2 years. Can it handle the pain? Yes. But what happens to value? Value will certainly go down because the earnings will collapse, but they're not going away forever, right? They're going away for 2 years or maybe 3 years. So you put that in your mental model, DCF model, and figure out what is the impairment. There is an impairment, but the market price will be down 70%, and the actual impairment that is warranted is maybe 15% or 20%. Because if you remove 1 or 2 years of near-term earnings in a business that is going to grow its earnings over a long period of time, very intuitively, the impairment is not 70, 60, 70%. So that kind of thinking is very helpful when you have that mindset. But it's again, the problem is psychological. When it was March 2020, it's hard to think that the world is not going to come to an end, because when the world is thought by people to come to an end, then DCF is not very relevant, because at the end of the day, if the world is actually going to come to an end, then the present value of future cash flows don't matter, right? Because there is no future out there. So if that's what people are thinking, your assumption has to be almost always that they're wrong, that things do recover. Humans have a way of creating a lot of problems, but also solving problems. So, and that happened. That's exactly how it played out. And the assumption that all businesses are not worth owning also turn out to be wrong. Some businesses thrived in that kind of an atmosphere. Some businesses got hurt. Some businesses benefited massively when COVID went away because of the pent up demand that was to be fulfilled, and so on. So there are so many things that happen. And to assume that all businesses are not worth owning and get out of equities and go into bonds was almost always a wrong idea during such periods, at least historically speaking.
I have another follow-up on that. So this was an interesting point. So while you said that you will look at some businesses where probably because of COVID, their earnings will be impacted for maybe 1 year or 2 years, and but the business is going to be there. The balance sheet is going to be very strong. And I'm just adding another aspect to it. The industry is also the competitive intensity of the industry is going down because there are a lot of unorganized players. I don't want to name an industry and name companies here, but just a construct here, because we actually went through that and I actually felt this thing. So the competitive intensity has gone down. The balance sheet is strong. The earnings, at least for the next 2 years, is going to be significantly impaired. Okay.
Yeah.
Now you realize the opportunity and you buy the stock. Okay. Now let's fast forward 2 years. The earnings have still not come up, But the COVID is again is past us. The market's view of that business and that industry has suddenly become much more favorable, and the stock has also gone up a lot. When I say lot, maybe a 2x or a 3x from the level of March 2020. And you still recognize that the business do have a tailwind, and the business does have the earnings, but how much of that is already in the price is the dilemma. How do you get
So the way
look
to
at
do
this?
that is to think of cycles. You have cyclical industry. How do you evaluate cyclical industries? In a cyclical industry, you use averages, right? You don't look at PE multiple based on last 12 months earnings, because earnings are inflated. A low PE multiple, when the PE multiple is calculated based on peak earnings of a cyclical industry, is actually a trap. And people who invest in cycles know this, right? They don't calculate PE multiples based on TTM. They calculate based on average over average, year over a cycle. So they take the good years and the bad years, and as Graham used to say, average the past, and always try to average the past. So in cycles we do that. Basically, the idea is that there will be good years and there is the bad years. Then averaged out over a cycle, this is what a business makes on a per year basis. Therefore, this is the average EPS, and this is the price, and this is the multiple, and therefore it's attractive. Why can we not use the same framework while evaluating businesses when they get hit by something like a pandemic? The same logic applies, right? So, how cheap or expensive the business is based on average earning power. Imagine that the period during which COVID happened was an extraordinary period, not likely to be repeated for a long time, and therefore the earnings that were not earned were extraordinary losses. Just like you trying to ignore extraordinary profits while doing valuation, or you put very low multiple on that part of earnings that are truly extraordinary, not likely to be repeated. Same logic can also be applied to losses, right? So I don't know the name of the stock. I don't need to know, but the method to follow here is how cheap or expensive the stock is in relation to normal earning power compared to other opportunities that you also have at any given point of time, because you have limited capital. Everybody has limited capital, so it all depends on how attractively priced the stock is based on average past earning power, or what you can visualize in the next 3-4 years on average. What is the average earnings that the business will make on an annual basis over the next 3-4-5 years, or what do you think the business will be earning 3 years, 4 years, 5 years on the road? How expensive it is. The stock may have gone up, but as you said, the earnings have not caught up as much as should have happened. Therefore, the multiple has gone up. But if earnings will catch up with with the past deficit in earnings in the next 1 or 2 years, then it might make sense for you to hold it. You really have to make that judgment, and it's not going to be an easy judgment, by the way. It's never easy to make these judgments, because there's always something else that is going on which looks much more compelling, and then you switch out of that into something which looks more compelling, and it turns out that the other thing went up much more than the one you bought. So those things happen all the time.
That reminds me of that quote. I don't know who said this, that capital is limited and opportunities are unlimited. So that is also a problem.
Yeah.
So moving on to the next question on valuation. So what's your general sense of valuation of the new age startups that got listed on the exchange in the last year? So there was some huge euphoria at the time of the IPOs, and now we know that they have all fallen somewhere between 30 to 70% from their IPO price. So we all know that these startups are becoming an integral part of our lives. But the $1 million question is, how can investors value them? What are your thoughts on this? Is market painting everything with the same brush, and is there an opportunity for a hardworking investor here?
Well, anybody who studies history of markets would have seen the same story play out. It's like not the first time it has happened. IPO bubbles have been very much a part of life of a stock market in almost every country. So, and every story, the outcome is the same. IPOs turn out to be a sort of a sucker's game. I mean, it is a rigged game, but many men want to play that game because some IPOs have done well for their brother-in-laws. And then there is FOMO, fear of missing out, and there is ROMO, the regret of missing out, because you've seen your neighbor getting rich, or your school buddy getting rich, or your brother-in-law getting rich, and then you even call up a banker and fight with them as to why they have not given you the loan to invest in an IPO, and you see the consequences of that. It's a different story altogether. But on the other side, the side of the sellers and the agents, there are these hugely perverse incentives. It's totally a rigged game. I mean, anybody who studies the structure of IPO markets would come to that conclusion. And this is not going to change. Human nature is not going to be changed anytime soon, right? And predators and prey are always going to coexist in the market jungle. So that has happened. It may be unfortunate, but it's not something that won't happen again. It will happen again. But let's look at the other side of it. What do IPOs do for society? And I think they're hugely beneficial for society, because IPOs are that's how the number of companies grows in the market, right? That's how new businesses come into existence. That's how businesses get incubated privately and then they go public. That's how they raise capital, and then by offering their stock to the public. And that's the basic essence of capitalism, right? So I think IPO investors are doing public service by funding these businesses. They buy these. They, of course, they're not thinking they're doing public service, but by the presence of these so-called speculators, people who think they will flip it for a quick buck, and some of them will successfully, which brings in hordes and hordes of others who won't. Because of these people, these businesses come into existence in the stock markets, right? So, and if history is any guide, and a good guide, and I think it is, many of these IPO companies will disappear from the market. They will just, they'll get delisted. The stocks will go to zero, and that's the nature of the game. It is the way it is. But some of them will become Wipros and Infosys and whatnot. They will turn out to be outstanding businesses, and they will become available at attractive valuations. So I agree with you that it is a good place to look for value in IPOs that have fallen a lot. But a couple of observations here. When you say stock is down 60% from IPO price, or 70% from the peak valuation post IPO, because after the IPO, if it's a successful IPO, it goes up a lot and people end up buying it, and then it drops and drops and drops. So those are just anchors, right? Those are just numbers which are floating around in the head. People start thinking it's cheap because it's down 70% from peak valuation, or is down 50% from IPO price. But that doesn't mean anything, right? Those are just numbers. At the end of the day, the number that really matters is how cheap it has become in relation to its earnings or earnings capacity. Maybe not now, maybe a few years down the road, no problem about that. But you can't just assume that it's cheap because it's down 60%. It may still be too expensive. Then there is the other problem about looking at IPOs that have fallen a lot in the recent past, and the reason for me in particular is that there is one component of diligence in at least my framework, which is to do with behavior towards minority shareholders. And a company that was listed only 3 quarters ago or 2 quarters ago, there isn't enough data out there for us to have a good way of figuring out. It may be a great business. It may have been run very well by the people who ran that business while it was private, but now it's public. How will they behave with minority shareholders? I don't know that right now. There isn't enough data for me to study to evaluate, how fair they have been, because there hasn't been a period long enough to make that judgment. So that's the other reason why I am not so keen to look at recent IPOs. They may have dropped a lot. They may have looked cheap also in relation to earnings, although that's not the case, at least when I looked at them in the recent past. But therefore, it makes sense to wait out a few years. So there's no rush, right? These companies have come into existence. If you look at history, all companies that have created wealth did IPOs at some point of time. So at the end of the day, everybody who's buying something today and has done well in it has actually investing in some past IPO. So clearly, there will be time to buy it. It's there in the market. It's been exposed to market discipline. the other thing that has happened is that unlike in the past cycles where companies were private and they genuinely came to market to raise money for the company, today it's not the case. Most companies that are coming to market, they have already been funded by an industry, the VC industry or the private equity industry, and the reason why they are coming to market is because they need to give an exit to those people who backed these companies in the past. And that changes everything, because then there is, you know, opposing, there's conflicts of interest and so on. But that's not the point I'm making here. The point I'm making here is that because these companies have come to market, now they may not actually be run in the same manner the way they were run in the past. In the past, when they were being funded by private equity investors and venture firms, they may have been run in a manner which was very different from the way they would be run right now. We are seeing that right now, by the way, in many of these companies that are cash consuming companies, but which went public at valuations that make us wonder what the hell was going on. Now these companies are operationally being pressured by the market discipline to generate cash. So, you know, the point I'm making is there is a before and after story that is playing out over here. The company before IPO was a different company. It had different owners. It was run differently. It was valued differently. There was ratcheting valuation through various rounds of funding. All that was happening in a market which is not a market which is dominated by millions of investors. So it's not as fair a market as the stock market is, structurally speaking. And now this company has gone public. Now the public market companies typically, at least in the long run, people want to see cash flow. They want to see earnings. They want to see EPS. They want to see growth in EPS. And many of these companies have come to market with no EPS, negative EPS, huge losses, cash consuming, and always dependent on the kindness of strangers. But now they have been exposed to market discipline. So operationally, they are run very differently. So the point I'm making is that when you're evaluating a company today, you have to think about how it will be run in the future, not how it was run in the past. And the future might be actually completely different from the way it was run in the past. And that's a factor that should get into the thinking of people who are looking at potential IPOs. But it's a good place to look for value in the long run, I think.
Fascinating, sir. So just a follow up on this, as you said that it is not very, as in the public market investors are not used to looking at these loss making startups. So we have some precedents in the US market, as in loss making startups got listed. So what has been the history there over the last 10 years, 15 years? What has happened to those companies or those startups, loss making startups getting listed on the US exchange, and how they have performed? Based on that, what would be your view, as in general?
So I go by what Charlie Munger once talked about, the Rembrandt valuation. He says, you know, Rembrandt, it's like a painting, right? It is, I'm basically making a point that a business that earns nothing and won't earn anything for a long period of time, it doesn't have any value, but the entire valuation could become anything and it could remain high for a long period of time. So merely because in a market, let's talk about US, for a period of 10, even 15 years, which looks like long term, there has been a period during which some companies which actually don't make any money and are hugely cash consuming, but are doing something which is life changing for tens of millions of customers that they have acquired over this period, are being valued by those markets at tens of billions of dollars. That this will always be the case. That I could never buy that. You know, I have always been a student of value investing in terms of the value of an asset is the present value of its earnings. If there are no earnings this year, no problem. You have to earn more the next year to compensate for the earnings not made this year. If you don't earn for the next 5 years, no problem. But in the next 5 years beyond that, you have to earn that much extra to justify the loss of earnings in this period. So that's the mindset, DCF mindset, that I have been sort of brought up with, and it's not easy for me to let go of that. And merely because there has been a period of 10 or 15 years when that model was not applicable. You know, this is the problem with financial market, that there is sometimes periods which are as long as 10, 15 years, when people start thinking this is the new normal. This is the way it is. The old systems don't work anymore. But that's not logical. At the end of the day, if you believe in DCF, then you have to recognize that the value of an asset is the present value of its future earnings. If there are no earnings to speak of, then there must be a lot more earnings in future periods to compensate for the time value of money. Now, in a world where interest rates are 0%, you can get that, 1 or 2%. But it's stupid to assume that a period during which interest rates for 1 or 2% will remain like that. At the end of the day, in DC, if you bring down the discount rate to 0%, you have an infinite value. And that's what these people want to believe, that these businesses are worth infinite, and there will be all kinds of vested interests which will want you to believe that that's the truth. And then when everybody is doing that and people are making money in their environment, you start believing, well, that is the truth. But that's not the truth, right? At the end of the day, the moment you de-anchor the value of an asset from its underlying cash flows, you can get insane. There's no limit to the insanity. And merely because the insanity has persisted for a period of 10 years or 15 years and has been popularized by people who are highly respected, doesn't change the fact that it is insanity. So every time, my suggestion here is never to lose sight of the fact that at the end of the day, the fundamental factors that Ben Graham wrote about matter. In the long run, that they are the only things that matter. There has to be earnings. And I accept the point that a Zomato and a Paytm could become very, very popular, powerful companies many years down the road. But they have to justify that. They have to make money. They have to make tons and tons of money in future years to compensate for the money that they don't make right now, to justify even their current valuation, despite the drops that we have seen. These are wonderful businesses from the point of view of society. If you think about it, because they generate so many jobs and economic activity, and they make the functioning of society so much more efficient. And they may also be good businesses from the customer's point of view. We all use these services, right, almost on a daily basis, and we now know how convenient life has become. Any food that you want can be brought to your house in the next 30, 40, 50 minutes. And you don't need to carry a wallet in your jeans anymore. And so they are they're hugely beneficial for society, for customers. But are they good from the point of view of investors who are not in the flipping game? This is the key here. And to answer that, who are not in the flipping game, which means the ones who flipped out in the IPO, we're not talking about, they were never investors in my view. From that point of view, is there a real margin of safety? Is there real earnings out there? Are they really making any money? And if they're not making any money right now, will they make a lot of money in future years to compensate for the period when they don't make money, in a world where interest rates are going up and the opportunity cost of capital is going up? I'm not so sure about that, but that doesn't mean that I don't have an open mind on it. That may happen. But the point is that at the end of the day, you have to recognize that the value of anything should not be de-anchored from the underlying fundamentals of the business, which is essentially operating cash flows.
Yes, sir. And if I remember correctly, so there is also an element of survivorship bias also. So you can look at something like a Facebook or an Amazon or a Google, where they are producing insane amount of cash flow and profits today, and you get into that feeling that, okay, they were also loss making at one point of time, but look at them, how they are. But the probability of, or the number of companies which have went on to make something like that is very, very, very few.
Yeah, you have to look at the graveyard.
Graveyard, yeah. So we are just now entering towards the last stage of the interview. So this question is from an individual investor's perspective. So if we were to start investing with a very small capital of, say, 5 lakh or 10 lakhs today, what would be your overall investment strategy?
Okay, so basically in any activity you want to have a competitive advantage. Small can be a competitive advantage too. So why to get into an activity when you're competing with the big guys? So my suggestion would be two, basically. One, find basically micro caps, invest in really tiny companies where the big guys have no interest. They, even if they had an interest, they could not invest because of obvious reasons. So there is less competition over there. And the second suggestion would be that there are so many others like-minded, and technology allows you to collaborate, right? So there are all these platforms. Yours is one of them, by the way. There are these like-minded people who have ideas, who can talk about them with friends, and group of investors who have similar capital base and who want to grow that over a period of time, and try to find somebody to talk to about them. So my suggestion would be focus on really beneath the radar business. Think again, competitive advantage. How do you want to get how do you get an edge? Because you want an edge because there is less competition. Less competition in uh, there are opportunities in mega caps also. That it happens, no doubt about that. But then over there you are competing with a whole lot of people out there. So my advice would be to focus almost exclusively on micro caps, micro cap investing, and find ways to collaborate with other similar investors using technology.
So, sir, taking that point further, if we are thinking of investing solely on, say, micro caps, how important would be to know the management or approach the management, because these micro cap companies' balance sheet is not filled with too many information which we need for our research, and even on the internet also you will not find too much details about that. So
That's
how
why
much
the
important is
scuttlebutt
that?
approach is. That is why the collaboration, right? That is why you need to have a lot of. You see, with a limited amount of capital, you don't have the budget to do a lot of research, on the ground research. And you're right, because you're investing in a micro cap. These are small, tiny companies, and they haven't been around for a long time, and therefore they may be under research, no doubt, but they also carry certain risks which are not there in companies that have been tracked for a long time. I'm not saying that you don't have frauds in large companies. In fact, we've seen some of the largest frauds in very large companies in the recent past, and that's not going to change. So you can lose money because of misgovernance in a large company or in a small company. The diligence is required no matter what. But for a small investor with limited capital and inability to get access, you need a network of other people, other like-minded investors to share intelligence without getting into obviously the unethical aspect of getting into insider trading and any of that stuff.
Right, right. The next question would be related to Warren Buffett and Charlie Munger. So you introduced Warren and Charlie to Indian investors. We all know how important they are in shaping your investment philosophy. Today, at this phase of your investing life, do you reread Charlie Munger more or Warren Buffett, and why?
Well, I haven't measured the time as to who I read more, but I do read them, and I reread them because I'm a teacher, right? So I have to. I'm doing a new course coming up in Flame University. I've done it already at the undergrad level, but I have to now do a workshop. I'll be repeating it again in November, I think. It's called Case Studies on Business and Investment Analysis. Now, this course is basically going to use real life case studies, Indian and non-Indian, to illustrate some key ideas for both analyzing businesses and for making judgments about the attractiveness, their attractiveness or otherwise as investments. So these are key ideas. I call them sort of first principles. And but where do they come from? They come from the works, primarily from the works of Mr. Buffett and Mr. Munger and their own teachers. So yes, I necessarily revisit the writing, but the way I like to do that is to think in terms of first principles. They have some ideas; they're very powerful, and there are these examples. So the way as a teacher, what I like to do, what I want to do, is to basically talk about that example, and then relate them to the first principles, and then use those principles to extrapolate on more cases and so on. So the reason I read them, I necessarily have to read them and reread them, is because I teach using their raw material.
That reminded me of I attending your lecture in Flame University in 2017. That was fascinating. I would have applied this time also if there would not been a family emergency. I don't know whether you would have allowed me to join again, because I remember during 2017 also that was a problem. You rejected me at the first instance, and then I had to again apply and request for the.
No, see what happened is earlier I was not an MDI. Now I'm at Flame. So I was at MDI and my commitment was primarily at MDI. Now Flame is firstly it's a wonderful place to be in. You've been to the campus, you've seen how wonderful the people are and the campus is and the facilities are. And it also is also the place where a lot of value investors get together. So it's a great place to network. And I am now more involved with Flame than I have ever been, and I'm designing new programs. So this is just one, and I know that there are people who will benefit from that. And earlier we had to reject because there was oversubscription, but now what we are doing is I will be offering it more times, maybe twice in a year, and if time permits, maybe thrice in a year. So if you don't get accepted in the first attempt, you will get accepted in the second. By the way, the reason I would have not accepted you is not because I don't want you in my class. The reason is that I want to give first option to those who know less than you. You already know a lot, and there are many people who I know who have applied who are already accomplished value investors, and I had to unfortunately this time decline their admission because my preference is to teach to those who don't know enough, and then I will ask my other friends who applied earlier and could not get in to come again, and maybe November I'm going to do it again. So you can apply, and hopefully I'll see you on campus in November.
Great. I'll definitely do that, sir. And one of our Mission Smile member and also one of my close friend, Vikas Kasturi, he has also applied, and I think he got selected.
Vikas is the next student, right?
Yes. Vikas was in MDI, but
Yeah,
I
yeah.
think he was a marketing student. I don't know whether he attended your class or not.
No, he did. I do. I remember the name.
Okay. Okay, great. Vikas, are you there? I don't know whether you're here or not.
Yeah, yeah.
Okay.
Yeah, Ankit, I'm here. I'm just having goosebumps. Professor remembers me.
Great, great.
Yeah, so sir, I attended the Flame program in 2016 also.
Okay. Yeah. I remember your name. I don't remember whether I met you in MDI or I remember met you in Flame, but I do remember think of you as one of my ex-students, so it doesn't matter.
Thank you,
So
sir. Yeah.
happy to meet you soon again, Vikas.
Great. So, sir, if you have 10-15 minutes, we'll just take up few of the audience questions before we wind up.
I know it's been a long session. We started, it's on 2 hours already. Okay, yeah, I'm here.
At least I didn't feel like 2 hours. So, first question is from Dr. Suvid. He asks, reading books, spending time practicing in the market, and networking. What has helped you the most in your investing journey?
See, I don't like the idea of spending time in market because there is no market to spend time on. I don't monitor prices on a daily basis. I do like to read about businesses, and I have a very multidisciplinary approach to thinking about investing. You need just like you have a DCF frame of mind, you should have an investment frame of mind. That you are reading a book and then you ask yourself questions about how can this be applied in the field of investing. So I like doing that a lot. If you're reading a book on biology and you're reading something on evolution, you start seeing parallels between the field of evolutionary biology and that of the world of business and investing. So you start thinking about extinction events, and you start thinking about fitness landscape. I mean, there are all kinds of models that come from biology. You start thinking about the co-evolution, basically that species evolve together, and the predators get better and the preys get better and their populations are kept in balance. So you start reading, you start relating to ideas like competition. So there are a whole lot of things that you start thinking about because you have an investment or a business frame of mind, because you're reading a book which is totally not in your field. So this is the way I like to do it. I don't read a lot of investment books now because even though they are extremely well written, a lot of them are a repeat of something that I read many years ago, and maybe a great example illustration about the point. But I actually like to do my own reading on subjects which have nothing to do with finance and investing and accounting, and sort of relate those ideas to the world of investing. Then, of course, I read a lot of business newsletters and newspapers and stuff, and again try to read up or relate them to what is happening in the field of business investing in India. So that's again a separate aspect of the time that I spend. So I don't watch any of the TV programs on the markets as such. Um, I I do admire people on Bloomberg Quint. Some of them write very well. So I read their columns, but I don't watch the channel. So I don't. So there are things that I do which are, and the time is limited. I probably miss out a whole lot of things that I should be doing. But well, that's the way it is. There is too much to read or learn from out there, and you have to figure out what you can give time to.
Right. The next question is from Avadut. He asks, in Sir's previous interviews with Capital Ideas, Chetan Parikh, he has given easier ways to gauge margin of safety rather than valuing businesses, such as how to value debt-free companies. On similar lines, I would like to know whether Sir has developed some new techniques, especially in case of understanding new age tech companies. Have you
No.
developed something?
No, I have not. I have not actually. I'm an old fashioned. I'm 56 years old, and it's difficult to teach an old dog new tricks. So I don't have new ways of valuing new age business models. I look at them with fascination, some of them with admiration as a customer. Also, I'm in deep admiration of the entrepreneurs who have brought these businesses into existence. We should not mock these people. You know, a lot of people in our community mock them. That's not a good thing to do. These guys have given their lives building a business which may not be profitable, but they have created tens of thousands of jobs. They're putting food on the dinner table of millions of families. They are changing the way India functions, as I mentioned earlier. And we want more of these people to come. And it's not right for us to mock them because they took the company public at a valuation which was extreme. Maybe it was not in their hand. You know, you don't know what is. You've never lived the life of an entrepreneur. You don't know what he or she has gone through. So let's not try to become too critical about these people. Some of them are, I think, extraordinarily human beings, and they're great role models for all of us.
His next question is also related to special situation, which you used to do extensively in the past. I don't know whether you are still doing it or not. So he asked about how does you look at the current environment and whether arbitrage is slowly diminishing due to market efficiencies.
That may be the case. I'm not so sure. I don't track the space very open. I mean, I know people who do this. You know, there are people. Ekansh Mittal does it. Some people I know are doing a lot of work in that space. So they may be better people to answer that question. But there are often opportunities that come once in a while. You know, buybacks or mergers or special dividends coming out. There could be opportunities in asset monetization thing that the government is planning to do. There are all these companies sitting on land parcels which could get monetized. So there are all sides, sort of esoteric things that are happening. It's always good to read about these things. You may not do them, but it's always good to be up to date about what is happening. And so there could be the reason I don't do that is a couple of reasons. One is there is a lot of reinvestment risk in these things because you put your money to work and it comes back in 6, 7, 8, 10 months, and then what? Then so if you invest in a business which you think will be around for a long time, then if you've done your job well, then you don't have to do anything after. You have to monitor, of course, but you don't have to keep thinking of new ways, new ideas to put your money to work. So it makes life easier. And of course, there is this trade-off which I talk about in class with students, and I give them a puzzle that if you had an opportunity to double your money in 6 months in an arbitrage versus an opportunity that will give you 25% CAGR over the next 20 years, which one will you take? And the answer is not that simple, by the way. Answer should change over time. For a person who is young and hungry, the answer is probably I'll double my money and I have the confidence I'll find something else. But there is a reinvestment risk. By the time your 6 months, you double your money, the 25% opportunity which will compound your capital for 25 years will go away. Sure. But the guy who has 10 lakhs of 15 or 20 lakhs, whatever the number is confident of finding something else. He wants to grow his capital. So the answer for that person is different from an answer from a person who's already financially independent and he's looking for ways of long-term compounding. So it's not an easy question to answer, and the answer is different depending upon the stage of the particular investor out there. But the reason I don't do it is because there's a lot of reinvestment risk involved in this, because of the stage in which I am. When I was younger and much poorer, then I'm poorer today than I was a couple of weeks ago. But I was much more poor when I was starting out. Then I would definitely would have done special situations, and I don't see anything wrong with that. By the way, special situation is also a great way of thinking about how the world really works, because it forces you to think about probability of something happening or not happening, and what will happen if it happens, and what will happen if it doesn't happen. And you have an expected value framework ingrained into you, and that framework changes because the numbers are changing. So just because of the passage of time, the expected return comes down, so you know what to do. So the actions come directly from your discipline of forcing yourself to think in terms of probabilities and consequences. So from that perspective, I think it's a wonderful skill to acquire for any investor. Whether you practice it or not, that frame of mind will always be helpful to you.
And sir, I'm reminded of a quote, as in a phrase which Vikas uses. So he also practices special situation. So he uses this special situation becoming more special. So, and I collate that with what you have written about Eicher Motors and Bosch in your early days. So that is also one good aspect of looking at special situations, where sometimes during those special situations you get a long-term opportunity in some stocks.
Yeah, you have to kick a lot of stones to find undiscovered gem out there. So absolutely, if you have to experiment a lot, and this is what I want to leave you with, is that young minds are here, and don't be afraid of making mistakes, because mistakes are not going to be very costly for now. Experiment a lot, see what works for you, and then invest more money and capital and time on things that have really worked for you, and that sort of agree with your philosophy. And the philosophy will also change. So keep an open mind all the time. So that's, I think, important to have. And whether in special situation, microcap investing, even in overseas businesses, there are so many opportunities that are opening up for individuals today that was not there when I started. So why not look at a broader landscape to think about what you want to do eventually.
I see a lot of questions, but due to paucity of time, we'll take, I think, sir, two last questions. Is that okay with you?
Please.
Yeah. So one is from Dhruv Ravani. If cash-consuming companies are a problem, what about? That's a stock-specific question, so I'll skip that. Dr. Madhav Bajaj, he talks about, can we compare this market with 2003 to 2007 cycle of commodity inflation?
I will know the answer in about 4 years from now.
I knew you were going to answer in the similar fashion. The last question would be, this is from Amar. Professors, this is a very interesting question. Professors' advice for small investors with relatively less capital was to focus on micro caps and research collaboratively with like-minded small investors. Question is, Once we zero on to promising stocks, do we diversify or bet big on selective 2-3 companies to attain scale?
See, a lot depends on other. So, see, at the end of the day, people who are starting out now, they hopefully have a source of income, which is like their operating business, and this is a treasury, small treasury that you want to grow. So, what you want to do is to make this treasury become large enough over a period of time that then you don't have to work for money, and the money works for you. So, you're not in that phase right now where you want to protect capital, you want to make capital, you want to make money, and that's very important. That you should do things with a more concentrated position with high conviction on under research ideas, because even if you're wrong, even if you go wrong, it won't destroy you. So long as you have faith in what you're trying to do, you will learn and you will pay a fee. It will not be a large fee. It may look large right now, but it will be a small in relation to the education that you get, in relation to the lesson that you learn, and how you would incorporate that in the long term. And the money that you make in the long term, this fee that you pay right now will look small. But if you got lucky and if you're right and skillful and it became 20x, 30, whatever the number is, became a lot of bigger money, that then you can switch gears and shift towards protection of capital. So, it's almost like, you are fragile right now. You are trying to become robust over a period of time, but you have to, everything starts fragile. Every business owner today who is very successful initially started with one product, one factory, one customer, and over a long period of time he has, thousands, millions of customers and dozens of factories and, hundreds and thousands of products. So that's the need, and he was taking risks that you would think of as imprudent, uh, uh, you know from an outside perspective. But that's exactly how money is made. Money is made by taking risks. Money is protected by avoiding risk. So take risks, take calculated risks. Don't do stupid things like day trading or playing around with derivatives. Those are things that I would highly recommend you avoid completely. Stay away from promotional companies, but there are opportunities for small investors in mispriced situations in microcaps. Stick to that, and if you find something that is very compelling, put your money behind it, because you have an operating business, an income from a job coming in that will cushion the blow in case you turn out to be wrong. But if you are right, your net worth could get a sort of a step function jump, which would give you the capital to become much more diversified over a period of time.
So what you are saying now is completely opposite of what you said in an interview of Vishal Khandelwal at Safal Niveshak in 2012. I remember reading that at that point of time, you were saying that when you start as an investor, you should be more diversified. And once you start gaining more and more and getting more and more understanding of the market and investing as a field, then you become more concentrated. And
Yeah,
here you are
because
saying
because you know I came across this whole idea of fragility and robustness and anti-fragility over time, and how businesses, how wealth is created. And I just don't want to rationalize what I said then. All I want to say is that no man steps in the same river twice, because it's not the same river and it's not the same man. So you're talking to a different person than you experienced in 2012 in that interview. I have no problem in admitting that.
just before winding up, your 2-3 book recommendation which you would have read recently.
Yeah, I don't like reading a lot of new books because they haven't stood the test of time. So I like reading books that have been around for a long time, which I haven't read and are highly recommended, or which I have read in the past and I learned a lot from them and I want to reread them. So I reread Shoe Dog, which is, I think, one of the most amazing books that I've read, about a founder. And just reading his story about how he created a company, how the founder of Nike, and how he built that business, and how he almost went bust so many times. Just to read it from a perspective of how fragile you are, and how you are realizing that you need to reduce your dependencies on so many external factors that are not in your control, and how one after another, you took care of that, whether it was originally started by him as a distributor of Onitsuka shoes. And it's so fascinating to see Onitsuka today versus Nike today. This guy started out as a distributor of Onitsuka, Japanese brand, in the United States, and he had to beg them to continue the relationship, give him shoes he could sell, and ultimately he realized that he is dependent on them, and they had a fallout, and then he ultimately created Nike. And to look at the market value of Nike today and the profits of Nike today versus that of Onitsuka. So it's a great story to learn about entrepreneurship and the struggles they go through and the kind of decisions they make in their life. So I really love that, rereading that book. I'm reading a old book published in 1999 called The Sovereign Individual. It's a very, very fascinating book. It makes you really think hard. I'm only just done about 50 odd pages in the book right now, but it's super fascinating, and I would recommend that. It has a lot of ideas written in 1999 that have come true. Some have not come true, but that they also acknowledge that that's likely to be the case. But it makes you think a lot. Then
Repeat the name of the book again.
The Sovereign Individual. Then lately I've been very interested in health. I've been reading books on some of the oldest techniques of having good health, and one of them is on breathing and how to breathe correctly. And most people I know don't breathe properly. Even I was not breathing properly until I read that book and started practicing some of the things. And reading books on the importance of sleeping and sleep cycles and the quantity and the quality of sleep and the consistency of sleep. And on fasting. Fasting has become a very important part of my life. I fast now almost 4 to 5 days in a week. I eat one meal in a day, and I absolutely love it. I feel better. I feel more energetic, and I don't feel hungry. And my weights come down. I feel, all my markers are looking better. Whether it is my cholesterol or my blood sugar or any way you look at it, so fast. And it's nothing new about it, right? So the point I want to leave you with is a lot of these techniques that I'm talking about, they're old techniques, old stuff, yoga or meditation or sleeping well or breathing or fasting. And these are great ideas. Much of wisdom is in old ideas, not in new ones. So I leave the new age models for somebody else.
That's a very good way to come to the end of this session. Just before we leave you or you leave us, any closing remark or any closing advice you would like to give to us?
Yeah, I saw some of the things that you've been doing. It was good to catch up with the work that you've done. What I like particularly about what you're doing, Ankit, is that you're not doing recommendations. You're not telling people buy this, sell this, target price, a lot of stuff that happens in this field. So you're basically focusing on business analysis, going into the quality of the business, the management, and not getting into the idea of whether stock should be bought or sold, or giving target prices. So I like that a lot. It's, I think, a big differentiator in what you're doing. So I would encourage you to keep doing this good work. And in any case, I think we should chat because there could be some interesting things that we could do together at Flame at some point of time. So I would love to know more about what you've done in the recent past and see if we can do something together over there.
That would be great, sir. And a part of the reason for me not going with this target pricing, or I think it has to do with interaction with you, because before taking the SEBI license, I met you in your office and we had a long chat. I don't know whether you remember that or not.
I remember.
So you gave me some principles, and so we try our best at SmartSync Services to follow that principle.
Okay,
So
yeah,
thank you
that's
so much for that.
I'm happy to hear that, and I hope all your fans who are here are happy with what you're doing, and I hope that the next speaker who comes will not be taking so much time and give much more wisdom in less amount of time. So,
Second on line is Vishal Khandelwal, because
great.
you followed by Vishal. I think Indian investing community has to owe most to both of you. So that is how we designed this. Starting
He's a
with you
colleague
and
of mine now. He's also a professor at Flame University. So I look forward to meeting him. Yeah, he's doing some amazing things. So very happy that he's going to be coming to you.
Thank you so much, sir. Thank you so much for your time. Thank you.
Thanks a lot. Bye, everybody. Thanks for having
Bye,
me.
everyone. Thank you, everyone, for patiently listening. Thank you, sir.
Thanks.